Good afternoon, everybody, and welcome to the last in our series of professional advisors working lunches for this year. We're partnering today with our good friends at Schroders. My name's Andrew O'Kelly, we're professional advisor, and I'll be your host for the next hour. Before we get going with today's session, let me just quickly run through with you some housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way. It just ensures that there's no background noise, so our speakers can be heard quite clearly. I should also inform you that this session is being recorded, and as usual, today's working lunch will qualify you for 1 hour of CPD. We'll be sending you your proof of attendance, along with a link to this recording, which will arrive in your inboxes next Monday. Do please feel free to share the recording with your colleagues. Now, as we look back on this year, I think we can all agree that 2023 has been one of the most challenging years for financial advisors for at least the past decade. As if the challenges of consumer duty haven't been sufficient, the industry is still dealing with an uncertain political landscape, a continued cost of living crisis, as well as the impact of the ongoing conflicts in Ukraine and in the Middle East. And it's at times like this that it serves us all well, I think, to take a really hard look at our businesses, check that we're running as efficiently as possible, and evaluate where the opportunities for growth will lie in the coming year. So with that in mind, what better time to take a look at the results of one of the largest surveys of advisors to be undertaken this year, and to present the survey results and shed some light on where the challenges and opportunities lie for advisors in 2024 are Benchmark's Commercial Director, Gillian Hepburn, Doug Abbott, who's the head of UK Wealth at Schroders, and to take the view from the advisor community, a great friend of professional advisors, Unique Financial Planning's Managing Director, Philip Martin. This session will give us an insight into advisor views on the markets, client investment sentiment, consumer duty, wealth transfer, implementation of AI, and sustainability, amongst others. Now, the information in today's presentation is so hot off the press that it hasn't even been seen by the press. So the official press launch of this survey is actually next Monday. So those of you attending today's session, you are getting a sneak preview. And for this reason, we won't be sending you a recording of the session until next Monday, when you will, of course, be free to share it with your colleagues. So do please respect the embargo on this information until Monday. Right, that's enough from me for the time being. Let's hear from Gillian Hepburn at Benchmark. Afternoon, Gillian.
Afternoon, Andrew, and thank you for having us on the call this afternoon. We're really looking forward to sharing some of the findings from the advisor survey and having a bit of a conversation about it. And obviously, we'll be really keen to take questions at the end. Just to recap, the Schroders survey started back in 2014, so we're nearing our 10th anniversary next year. It's always important to remember when the survey was conducted, because that often has an impact in the way some of the questions were responded to, particularly when it comes to markets, and Doug will cover that in a minute or two. So it was between the 20th of October and the 6th of November. And this year, the survey was completed by 254 advisors. So the plan for today is Doug, who's with me, is going to cover some of the market outlook and some of the more investment-related views. And we're going to stop at a few points and have a chat with Philip and get an advisor view. And then I will run through some of the advisor business challenges and some of the areas there. So I'm just going to hand straight over to Doug. He's going to start by talking about how clients are feeling about their investments.
Great, thanks very much, Gillian, and hi everybody. I think it's really important just to put this survey in context. So we took it over 2 weeks from the 20th of November to early November, as I think Gillian mentioned. Now, if we go back to that period in market, it was a pretty dire month, October. Essentially what was going on was you had the events in Israel starting to happen, the terrible events there, but also you had a real change in sentiment in markets towards interest rates remaining higher for longer than anticipated. I think some people have been talking about Matterhorn type interest rate cycles or Table Mountain type cycles. And I think basically in October, people started realizing that interest rates are likely to be higher for longer. So a sort of flat line a bit like Table Mountain, and that really sort of started to hit risk assets. So we had a bit of quite a significant sell-off in equities and bonds in October, and you can see here that, you know, most advisors that we're talking to were reflecting that in the number of advisors that were feeling bearish, bullish, or neutral. You can see an uptick in the bears, although interestingly a slight uptick in the bulls as well, kind of maybe pointing to some better times ahead. But that's what was going on in terms of overall sentiment. If we turn to the next slide, Gillian, we've been asking this question about kind of what the main concerns are from clients of advisors. And you can see that capital loss remains the highest. I think throughout the time we've been asking this question, it's always surprised us that inflation's been so low, and generating income's been so low, and rising interest rates been so low. It's all been about capital loss, which probably talks to the kind of types of client that advisors are advising. They tend to have capital already, so losing capital is the thing that seems to come top when we're asking them what are they worried about. Let's go to the next slide. And no surprise, we only started asking this question this year, but most advisors are having conversations with their clients about long-term investing versus holding cash. And I think we all know that at the moment, given how difficult markets are, the benefit of holding cash looks very, very strong for clients. All I would point to is that in November, markets went up 9%. So if you switched out of risk assets in October, you would have locked in the poor returns, and you would have missed out on a 9% gain. So I think you can never time the market cycle. It's good to stay invested, and I think when people have long-term time horizons, really need to tackle this cash versus investing kind of conundrum that we're all facing. And then the final question, I think, before we possibly stop for a discussion with Philip, is just talking about the number of advisors that have been talking about annuities versus drawdown. I think the kind of question of like post-retirement income and how you construct a solution for clients has completely changed with the onset of interest rates coming back at a higher rate for longer, and also inflation being reasonably sticky. So really interesting that 74% of advisors are saying that's something that they're really starting to debate with their clients.
Philip, can I just ask you quickly before we move on, does that resonate with the type of conversations that you're having with your clients?
It does. I mean, we tend not to have conversations with clients around how they currently feel about markets, whether they're bearish or bullish. Tends not to be a conversation that we would have with our typical client. But the cash conversation is definitely, I mean, everybody on this call will recognise the issues around trying to convince people of the long-term merits of being in the market when cash is earning what it's earning. So genuine new money onto platforms coming from cash is definitely far harder to get clients to engage with. And I think that'll carry on until those rates start to come off. I think the annuity one is very, very interesting. Obviously, that market's lain dormant for so long. It's very, very interesting to see how those who still participate in it are pricing on a really dynamic basis now. And you can move on one day when you're pretty clear drawdown is going to give a better outcome than an annuity, and 3 days later it could be entirely the opposite, depending on how providers are playing. So it feels to me, I can't believe I'm actually going to make this point, but it feels to me as though annuities are back in the mix, and it's absolutely a place that good advice will always be able to outweigh do-it-yourself kind of activity at retirement. So that does echo too.
Yep, great, thanks for that. And obviously we can cover that in some of the in the Q&A if that feels the right thing that we want to do. Let me just move on, because I think what we're going to look at now is just views on market trends and what expectations of advisors are in terms of, first of all, asset allocation. So Doug, over to you again.
Yeah, okay, thanks Gillian, and thanks Philip. So this just goes into a bit more detail about views on kind of asset allocation. And so you can see that for the last 12 months, advisors have been saying there's been an increase in allocations to cash, a significant increase to cash. What's really interesting is if you look at what they're saying about where they're going to be allocating over the next 12 months, it looks far more balanced in terms of the asset classes which people think are attractive. Now, clearly this comes probably from some of the outsourced providers that advisors are talking to, but it feels like kind of moving clients into investments and away from cash is something that advisors are thinking about on a forward-looking basis. We've asked for a while now, some of these questions about kind of what do you expect in terms of a number of different factors. And what's really interesting is, as you'd expect, advisors are expecting inflation will trend lower and interest rates will do likewise. This is quite interesting because I think we were all expecting that to be a lot quicker. Inflation has been sticky. It is starting to move down, particularly in the US, less so in the UK. Interest rates is a much broader question, and I think it'll be interesting to see how that plays out next year, because that will be quite a big factor in the way we're thinking about everything from mortgage payments to returns on cash to investing over the long run. So quite interesting, but advisors tend to think that both inflation and rates will be coming down. Going to some more thematic discussion. This is quite interesting, this chart. Gillian and I were talking about it just before the session. So I think the two things that come through strongly are, on the left-hand side, we've seen that coming from a reasonably high place in 2019 and 2020 during COVID, when everyone was working through Teams and on Zoom, there was a lot of interest in how, well, a lot of people saying disruption is going to really change. Disruption is going to come from technology. That dropped right down, and then it's come strongly back this year, which we think is probably related to AI and the launch of ChatGPT and kind of the discussion around that. But the other thing that's super interesting is disruption related to changes in the environment, where you can see from a place where people were thinking there was going to be a lot of disruption because of changes in the environment, and that's really coming down in terms of the way people think that's going to cause disruption, which I think is quite interesting, because I think certainly here at Schroders, but more broadly, people think that climate change is kind of only growing. So quite an interesting dynamic there, I think, coming through. And then when we look at other factors, you can see geopolitics is strongly on the agenda. You can see it was high up, it came down, and that was kind of roaring back, which is completely to be expected, I think, with what's going on in the Middle East and in Ukraine. And you can see the impact of higher deglobalization also coming through pretty strongly. And then what do advisors think that means for markets? So you can see that 25% of advisors expect equity market returns to be higher than average, and the proportion that think that bond market returns are going to be higher is about 35%. So in general, though, people not that, kind of thinking that things are going to be kind of in line with averages overall.
Just do this piece.
Yeah. Okay. We've got some questions now, just in kind of, which I guess are directly being asked because of the current situation around cost of living and inflation. So 89% of advisors have reported that some of their clients have adjusted their plans as a result of the cost of living crisis, and 27% of advisors report that more than a quarter of their clients have had to make some adjustments. So interesting that the cost of living crisis or the cost of living pressure is having an impact on clients. And I think this is a really interesting chart in terms of kind of the reasons cited around people's planning. So you can see higher household expenses is kind of the top reason that clients are seeing in terms of where they're being affected, so food, fuel, etc. And there's been a change since our pulse survey halfway through the year, where helping wider family was the second referenced reason, i.e. people who I guess were advised were helping out their family. Interestingly, it's only marginal, but mortgage payments has come as the second reason. And I guess as time goes on, as rates remain higher for a longer period of time, and people who have mortgages are having to renegotiate their mortgages or change their mortgages, I think you're starting to see that impact in terms of kind of how it's impacting people. And then this is a really interesting question. 35% of the advisors report that some of their clients have stopped or reduced making payments into pensions. And 20% of advisors report that some clients have stopped or reduced insurance payments. This will be very interesting to track over time, whether this grows, whether it comes down, how far this kind of period we're in of low growth, higher inflation, higher rates kind of impacts this. I think quite interesting. Would be quite interested to hear what Philip thinks about these bits.
Yeah, so Philip, in terms of that little section there, how much of that resonates with clients, both in terms of cost of living crisis, and then where clients are maybe taking money from?
Yeah, so I mean, there's loads of facets to this. I mean, I was encouraged that you have started to ask some questions about areas other than just investment, because no question, lower disposable income means people are less inclined to save. So at the regular savings end of our marketplace, that's definitely dipping. But I think it is interesting that you're asking questions about things like protection. And we do notice, not so much that people are looking to reduce cover or stopping premiums, because that's a very, very well-travelled path. And if it's there to protect a mortgage, then ordinarily we would be intervening and explaining that that's not a great thing to do. But what it is starting to impact is fewer people actually taking it in the first place, or feeling that they have the budget to be able to properly protect the mortgage, which I think is disastrous, obviously, in terms of their own future health and well-being. So that would be one area that we definitely concentrate on, around ensuring that people are adequately protected when they're taking that big debt out. So no question, it's going to impact on straight cash investments, but it does depend very much on which part of the market you're playing in. I mean, we've got a couple of advisors dealing with people in the city with bonuses that appear to be absolutely immutable and unchanged from anything that's going on in the outside world. And they would tell you that lump sum investment remains as high as it ever was. But in the mainstream market, no question is biting.
Yeah, I think it's a really good point, actually, in that, I mean, we'll come on to talk about consumer duty a bit later, but one of the things we talked about in the last survey is how much of this demonstrated the absolute value of advisors and advice, where, if people are needing to take money to help with cost of living crisis, is it being taken tax efficiently? Also helping wider family, is it a gift or is it a loan? So, helping clients navigate through what are kind of choppy markets, if I could call it that, and then these cash conversations. I think this constantly points to the value of speaking to advisors like yourself, in terms of, and also the long-term impact of stopping any pension contributions. Whilst accepted that people, if they need money, then they need to take it from somewhere, but an advisor is really going to help them work out where is the best place to do that.
Yeah, I mean, we wrang our hands about the inconvenience of having to do affordability checks and a far greater understanding of people's incoming and outgoings. But it's exactly doing that exercise that starts to open up conversations about different ways to economise within a household budget, rather than just stopping insurance or whatever it happens to be, or cutting the pension contribution down. Agree.
Absolutely. So we just finished Doug's section by just looking very briefly at some of the questions around sustainable investing.
Yeah, so quite interesting, because I think given everything we've discussed already, it feels like sustainable investing is really, or sustainability has really fallen down the agenda for clients and advisors. And obviously we've seen some quite poor performance from the really popular sustainable funds that took a lot of money, I guess, through the times when performance was strong. And we've got a couple of slides here that start indicating that. And obviously I mentioned the piece where we've seen climate change coming down the agenda in terms of where disruption comes from. Interestingly, you can see that 76% of advisors, say that they're aware of a link between sustainability and investing. But when we go into kind of some of the deeper questions, you can see that only 23% of advisors report that more than a quarter of their clients asked to incorporate ESG factors when investing. So it feels like something which clients themselves aren't demanding. And then moving on, interestingly, when you ask these questions about what are clients asking for, you can see that actually there's been an increase in the number of clients that, in the small decrease basically factor, and the small increase factor has been coming down as well. So I think it feels like, given everything that's going on out there, sustainability is falling down the agenda, and I think that's quite interesting. I think one of the things that has slightly gone wrong with sustainability is that I think it's been too associated with performance and investment, rather than kind of being a way for your money to be managed that causes no harm and perhaps makes you feel more, I guess, connected to what your money's doing and how it's being used to kind of nurture your savings, as it were. So quite interesting, a real change there. And I think perhaps, it's slightly been rammed down advisors' throats from the industry a little bit, and maybe we're seeing a bit of a backlash there.
Yeah, Philip, does that resonate with you? It feels from that last slide, it's almost like we're all broadly neutral at the moment. There's a bit of an increase and an equivalent decrease in terms of demand for sustainable investments.
Might be, but I think taking a short-term view of this, if you're trying to build a business that's going to be around in 20, 30, 40 years' time, you're going to have to realise that you're going to be engaging with a different demographic that feels differently about it. I'm not surprised you get that answer if you ask about existing IFAs, existing clients, because they're just thinking differently, and that cohort is entirely different to the 2 or 3 generations below them. I mean, I just saw there was a Twitter campaign going on last week, just naming and shaming the companies in which your auto enrollment pension could be investing, just naming all of the gas and oil explorers. You can see how that engagement is going to totally change as the demographic of clients changes. So I get it, but I don't really get it, because I think it's inescapable that eventually everybody's going to have to face into this. So any idea that this is just petering out, I think is for the birds.
Yeah, I mean, that's great to hear, Philip, because I think our view would be this is a great way to engage with the next generation and with clients. It's explained properly. I think perhaps we got carried away with, there were some sustainable funds that were performing really well in line with global growthy equities, and sold in that way. Whereas I think actually when you're engaging with sustainability and the client on it, it really helps kind of develop a proposition, which is a much better way of thinking about it.
Yeah, and we've got to get better at doing better propositions. You know, as an industry, we breed cynicism because we get a bunch of people all going out with Me Too's and putting new badges on old stuff and claiming that they're things that they're not. And we need to stop doing that. Otherwise, people are not going to engage with it properly. Yeah. But I'm looking at asset manufacturers here rather than people giving advice. But you take my point.
Yeah, I don't necessarily disagree with you. And I think look, last week the week before we had SDR announced. So you're going to start having labels that are pretty credible. I mean, I think we think SDR is going to be really good. It's quite sensible. They've included a mixed asset category, which is good because so many clients use multi-asset funds to access this area. So I think hopefully we're moving into kind of a better world on this area in the future.
Yeah, guys, just before we move off sustainability, I've got a question coming that's worthwhile just clarifying. Paul Rankin's asking, if the client's a charity, the sustainability preference request is far higher, isn't it? Are you saying clients overall or private clients only are included in this data?
That's a good question. The question is client, so it's that advisor talking about their entire client base. It's hard to say. I think you'd probably generalize to say most of the advisors we speak to are going to have a large majority that's private clients, not charities. So it probably reflects that more than anything else.
Yeah.
Good. Thanks for clearing that up.
Yeah, not at all. So I'm going to move on now to advisor business challenges and just look at what is happening here. And it's probably no surprise, because it's very similar every year, that the number one concern for advisors as we move into the next year is around regulation. So you see that in the bottom chart. Regulation was quoted nearly by half of the advisors as the most, their biggest concern. And it's probably no surprise. If we think about what we've been through, we've got consumer duty still well underway. We've got the sustainability regulation that Doug just mentioned. We've had numerous Dear CEO letters, and we've also got the retirement income review underway. So just lots happening in that space. And then a focus on finding new clients and servicing existing clients are still coming up high. It was interesting that probably succession planning or exit strategy fell down marginally, not massively, but it's just dropped a little bit over the last year. And it's always great to debate why that's happening. And, we can have a look at that if you want in the Q&A session. We then asked about downward pressure on fees and the advice charge. And it's quite similar. 44% of advisors said, yeah, there is some downward pressure on the advice charge. But I think what's interestingly, if we look at what they're actually charging, it feels to me like, whilst there's a downward pressure, we've seen a significant increase, particularly around the number of advisors charging between 0.5% and 0.75 on an ongoing basis. You see that bar there shot up to 53% of advisors, which is increased significantly from 37% last year. And you see the corresponding drop, interestingly, in those charging up to 0.5%. But I just thought it was interesting that whilst there's a pressure on fees, it's not really coming through in terms of what we're seeing. We've asked about segmentation for a number of years now, and it was interesting that between sort of 2018 and 2020, as the PROD regulation came in, we saw an increase in the number of advisors segmenting their client base. And then it kind of tailed off a bit, but we've seen a little uptick in the last year. And we think that's following the introduction of consumer duty and looking at products and services and whether or not we're selling them within the appropriate target market. So that's our take on this one. Always happy to have a debate on it. And then another interesting area, we asked about where or how client advisors segment their clients. And we saw a decrease over the last few years in terms of advisors segmenting on an assets under management basis only. And then that's increased by 20% in the last year, which I thought was quite interesting, because what we thought was happening was that there'd be a shift more to client life stage. But that's kind of gone, it's a bit up and down there. So interesting, last year we had this huge rise of other, and we weren't sure whether that was just a combination of the two. So we asked this year for anybody that said, I do it another way, what happens and what do you use? So that was around complexity of client situations and the servicing requirements. So kind of a bit of a mixed bag here in terms of what's happening. And then we asked about outsourcing. Obviously, running our solutions business here in Schroders UK, it would be remiss of us not to ask about outsourcing of portfolio management. And what we're still seeing on the left-hand side here is that only about 20% of advisors are saying that they don't do any form of outsourcing. So that could be to multi-asset funds or model portfolios. But 36% of advisors now outsource more than half of their clients' assets under management. So we're continuing to see this shift towards outsourcing, and that's certainly something that we're also experiencing within the business when we work with advisors. And we do think there is a consumer duty lens there in terms of many advisors who were delivering their own model portfolios suddenly finding themselves having to write target market documents and fair value assessments. And certainly that's coming through in some of the conversations that we are having. But if we look at where they expect to increase their allocation to outsourced solutions over the next 12 months, we're seeing a similar pattern to last year, with the predominant area being to multi-asset funds. So 27% of advisors said we would move or allocate more to multi-asset funds, 25% to model portfolio services. And again, our take on this is around the changes in CGT. So again, that's one to watch, particularly next year as we move into a different environment on tax, and whether or not this will come through in terms of fruition. And there's not a significant change in terms of the factors that advisors use when deciding whether or not to outsource portfolio management. Improvement to their operational effectiveness and, interestingly, more time to spend with clients has increased quite a bit there. Again, I think that's partly maybe due to consumer duty and thinking about what clients value. And the one area that was, it usually came in at number one, was always access to investment expertise and resources. And actually that's coming at number 3, only marginally. But whether that's just maybe a given now, that's just what advisors would expect, is certainly something to debate in terms of outsourcing. And then the two factors that remain most important in terms of actually selecting which provider to use are around performance and costs. So an investment process often follows in third, and for us that's about having an investment process that advisors can explain very easily to clients, and that it's aligned right across the range of solutions that we offer. I just finished quickly on private markets and then go to Philip, but we've asked for a year now about private markets, and it was really interesting that in May of this year, the number of advisors thinking about using private market investments had increased from 11 to 21% now. I'm a simple person, that felt like nearly double to me. So that was very encouraging in terms of that number. It slipped away a little, but this is back to, it's quite important to consider the timing of the survey, because shortly after the survey was the announcement from the FCA about the ability to make LTAFs available, or much more available to retail mass market clients within ISAs. So it would be really interesting to see whether that result at 16% would have been higher had we run this survey just a couple of weeks later. But maybe that's something again that Doug can pick up on when we come to the Q&A session. And Philip, anything there that's caught your attention in terms of how you're managing your clients at the moment and outsourcing?
I thought the stark number was the huge jump in the proportion of people citing regulatory reasons as the rationale for outsourcing. And I think now that the penny's dropping, that if you're going to put portfolios together yourselves, you're going to have a whole raft of quasi-manufacturer type hoops to jump through. I think that trend is only going to accelerate unless people take discretionary permissions themselves. Genuinely think that in 3 years, the number will look dramatically different to the number it is now.
Yeah, that's interesting, and that's the great news about the survey, is having these long-term trends. And as people on the call might have spotted, some of the questions we ask are quite new, and then others are ones that we've asked for years and years to just continue to build a picture. But the great fun, if I could call it that, about running our own survey is sitting down for the few weeks before we run the survey to say what do we think are the key points and what do we want to ask advisors. And therefore coming up with relevant information.
It does occur to me that some elements of the survey, I mean, it's going to be as broad as it possibly can be, but they almost run contrary to each other. So spotting trends and increase in outsourcing is completely contrary to asking questions about what people think about individual asset classes. I know that in particular was aimed at what do clients think, but it could equally have been posed about what do advisors think. And we spend a lot of time in our business trying to disabuse our advisors from having opinions about that, because if it's a long-term investment, I don't really care what you think about it. It should just be something that's suitable for the medium to long term, and it should be in a sensible asset allocation strategy put together by somebody who knows what they're talking about. And short-term views are great, but they're just short-term tactical views. And if you want to do that with a punting pot off to the side, that's fine, but that's not where the core of the advice should be built around. Just occurs to me as you see some of the answers to those two parts in particular.
Yeah, it's actually a really good shout, Philip. I mean, obviously some of these questions have been in the survey for nearly 10 years now. So before we really launched the solutions business, 3.5 years ago now. But it's a really good point in terms of advisor behaviour with regards to the investment proposition, and we maybe need to rethink.
Maybe we should have. I'm not interested. Someone else does it for me. And see how many,
but it's true. I mean, our advisors in our base that have the strongest relationships with clients recognise that discussing the last 6 months' investment performance is on the agenda, but it's agenda item number 7 or 8. It's not number 1 like it used to be. And they're deliberately making a sort of second order conversation to just proper planning, remedial planning, all the other things that go alongside the service that they offer. It's definitely changing.
Yeah, sure. And we need to make sure we continue to keep pace with that as well. I'm now going to move on to my absolutely favourite topic, so apologies for indulging myself for a minute or two, but as people who've maybe been regular listeners to this will know that I'm a massive fan of the wealth transfer space. And I think what's really interesting, obviously I've been talking about this for certainly 5 years now. I can't claim all the responsibility here, but we're now seeing that 63% of advisors are concerned that they could lose business as wealth transfers across the generations. And if you think about the shift in that over the last few years, that I think the direction of travel here is right. But maybe we're still not seeing enough of it filtering through. So the average age profile of clients remains largely unchanged. And I know, 49% of advisors report the average age profile has actually increased, so marginal increase on last year, but what we're still seeing is a focus on older clients. And when we ask about differentiated strategies for younger investors, that's still sitting at only down at 16%. And for any of you who have heard me talk about this current transfer of wealth to widows in the boomer generation, and the fact that another survey that we just announced to the press a week or two ago, that only 34% of these women stay with a family advisor, then maybe the 10% that are focusing on it are doing something right. But that is a whole other conversation, but we're still not seeing, I think, enough advisors really understanding this and thinking it through. And this is a slide I think I said last year makes me sad, and this year makes me sadder, in that the proportion of advisors that are prepared to accept clients with less than £50,000 has been steeply declining over the last 4 or 5 years. It's down to an all-time low of now only 25%, whilst on the right-hand side here, we're seeing the proportion of advisors that are only accepting clients with more than £200,000 has risen to nearly 20%. So it doesn't feel like we're, as an industry, resolving the advice gap here. But we understand fully the challenges of that, and obviously, you know, there's things that have certainly happened. If you look at things like pensions freedom, that's meant there are many clients out there, many wealthier and older clients out there. But it's just something to think through. I'm going to dive into consumer duty, and then I'll come back to you, Philip, on the wealth transfer and consumer duty bit. But we started obviously to ask about consumer duty back in May. And I love this slide because it shows a shift. Some of the slides will often give us information that we probably could have guessed, but it's great to get a number attaching to it, like the fact that advisors are expecting interest rates and inflation to come down. This one was one of the kind of aha moments for me, because back in May, we saw that, you know, 39% of advisors said that consumer duty would have very little impact on the business. And if you look at the shift in that now, that's dropped right down to 17%. So that's gone from 39 to 17%. And you've got this corresponding increase in the number of advisors that say that consumer duty, now that we've been through this first phase, if I could call it that, is having a high impact on my business. So I think maybe here reality is beginning to bite in terms of exactly what we have to do to comply with the regulation. And we asked a new question this time round in terms of, you know, what are your key priorities, particularly as we move into the new year? And by a massive mile, it was ongoing assessment of fair value and using client feedback. And as you heard earlier on the call, I've now moved to our benchmark business and working with some of our advisors where we have put a framework in place and the ability to ask clients about delivery of value. That was work that we did with Holly Mackay at Boring Money, where we developed a framework based on external research about what clients valued, and we built a questionnaire around that. And that will be implemented throughout 2024. So it's about, whilst we could all argue that, you know, beauty is in the eye of the beholder and value means different things to different people, it's about trying to put a robust framework around that to help demonstrate that we're really taking action and looking at it. So I thought that was an interesting area that it's probably no surprise that it's a challenge, but I think it's now about thinking how are we going to tackle this? And then, interestingly, 69% of advisors think that the fair value outcome of consumer duty will put pressure on ongoing charging models, and that's increased by 10% since May. So again, an interesting one here in terms of, is it the nature of the ongoing charge itself? What do we feel the regulator's direction of travel is on this one? But obviously earlier what I showed you is that advisors are also beginning to feel that there's a pressure on the actual fee itself. So it's both the nature of the charge and the fee. So and you know, a number of interesting things here. And 33% of advisors, back to that earlier discussion, are considering making greater use of outsourced discretionary model portfolios specifically as a result of consumer duty. And you know, certainly that's something that we've recognised within the business here. Philip, what's your thoughts on you know, consumer duty, for example, and also maybe wealth transfer?
Okay, well, huge topic, which we obviously talked on a lot before. I mean, I think the for us as a business, the two single big things for us with consumer duty is rationalizing what we charge broadly similar cohorts of clients, so getting to a broadly homogenous outcome, because historically advisors had quite a degree of flexibility around where they set fee levels. So you've got that, you know, indefensible point that two portfolios are broadly the same amount, the same complexity, are charged different amounts, and that needs to be tackled and moved over a period of time. That's one thing. And if it's difficult in our business, you can only imagine how difficult it is in some of the big consolidator businesses that have bought different businesses with completely different approaches to how that was tackled. So that's one. And the second is this particular point about how you demonstrate the value that you are adding when what you are doing is part activity and demonstrable and straightforward, and quite a high degree of what you're delivering is intangible. and very, very hard to put a price on. And doing that in a way that makes a regulator understand that it's not just about sitting down once a year. There's a whole raft of other things that go on in this business. There's reactive capability there's been there when people have got queries. There's been there to process withdrawals on a one-off basis when they need it, with some rapidity. That's going to be the hard bit around drawing that all together and being able to demonstrate that back to clients. And we've not completed that work yet, but it's still ongoing. We've got a handle on what the challenges are, but we haven't completed it yet.
Yeah, I mean, I think in my view, we'll start to see examples of, to quote the regulator, good and poor practice, and it's all about test and learn. If we look back to what we had to do for fair value or assessment of value for the fund business, it was a real learning exercise with the first round, and you looked at what everybody else was doing and how could we improve how we were doing that. And I think for next year, there will be a lot of people looking at what is best practice and how could we do this in a way that meets the regulations. So I think we've got a really interesting year ahead with regards to.
It does. I don't want to join any regulator bashing, but it's got a really strong part to play in this as well. It's all very easy to carp from the sidelines and talk about pressure on fees and how advice fees have got to go down. But if you're doing that at the same time as you're still demanding reams of paper to be produced and posted out to people, none of which are ever read, and you're still, making what I think are perfectly sensible changes around polluter pays and therefore driving up the cost of PI and capital on a balance sheet, that does not run at the same time as reducing fees. So somehow somebody's got to join this whole circle of regulatory change, pressure on fees and delivering to the customer, because they don't all exist in a vacuum.
Yeah, it's back to then why we're seeing regulation being the top challenge for advisors. I think it all interrelates. So I'm just going to end on I don't mean that last conversation wasn't upbeat, but let's end up with a couple of slides here on artificial intelligence and mainly things like ChatGPT. And back in May of this year, and if we all remember, artificial intelligence or ChatGPT that we've been able to access probably since Christmas last year for many of us was the first time we kind of played around with it and worked out what it was about. And we asked in May, did advisors see this as an opportunity or a threat? And it's really interesting, I think, to see this significant rise from 57 to 70% of advisors in what is a really short space of time, where 70% of advisors are now saying that, we think this is a real opportunity for our business. So we then asked about how soon did they anticipate including this in some way in the advice process. And again, kind of a bit of a startling result in terms of the increase, particularly in those anticipating that they would use this in some way in the next sort of 2 to 5 years, and in fact even the next year. So clearly there is a lot of activity and there's a lot of positivity about what AI can do. And then a new question that we asked this year was, well, if that's your thoughts, where do you think it's going to help? And maybe no big surprise, but really interesting nonetheless, that 63% of advisors said, well, we think it will be in efficiency and automation of the business processes. Now, what I also thought was really interesting, and maybe that's just given how I've played around with some of this stuff, is that the lowest or the area of least interest maybe to advisors was around this whole piece around client engagement and personalization. And I actually think that's where there's a huge opportunity to personalize contact and correspondence with advisors. Take one piece of content and deliver it in different ways for different target audiences. But maybe I'm getting ahead of myself here. But I don't know, Philip, have you started to think about AI at all within the business?
Yeah, I mean, when I read these numbers the first time, I mean, if it's 240 or so firms that have been involved, and it was 1 in 12 last year that thought they'd use AI in the next year, I'd love to have asked 20 of those businesses whether they did or they didn't. That felt quite a heroic assumption. I'd be pretty confident in suggesting they probably didn't. I actually personally wouldn't dispute these two issues about the areas that I think it'll have the most impact. I mean, I think anyone who's tried to speak to a chatbot and is connected to Virgin Media will understand that using AI to do customer interface is not necessarily the world's most brilliant way of engaging with your customers at the moment. And I guess there's another 60,000 other examples. So I think there's a way to go, really, before we genuinely start to believe that there's somebody at the end of that is actually genuinely going to sort things out. but I can, I think it absolutely will. If we carry on with SRs at their current length, with the playing back of fact finds in the way that we currently do, in the linking through from the fact find to the end fulfillment, then clearly AI can start to have a really big impact in producing a decent quality SR to 90–95% accuracy. And you move to using elements of your paraplanning function to check output, not create output, and that's going to have a big impact. Perversely, actually, I'm actually very positive about that. I think if I were a paraplanner, I probably wouldn't be, but I think if I were a paraplanner, I'd be thinking forward, thinking, well, now's the time to get my exams done and going into giving advice, because I genuinely do think that that personal interface is irreplaceable. It's the core of what we do, and I just genuinely don't see AI replacing that in full. So I think it may actually start to breed, faster newer advisors than we thought were the case. As is the case when technology replaces old jobs.
Yeah. Well, thank you for your views on that, Philip. And I'll remind myself not to contact Virgin. Andrew, I'm just going to hand back to you for and stop sharing for a minute here and hand back to you for the Q&A.
Of course. Well, listen, thank you very much, all three of you, for your valuable insights. I'm actually going to hand over the Q&A to our news editor, Sahar Nazir, who was meant to be hosting this thing. We'd had one or two sound issues with Sahar, but I hope by now we've managed to resolve that. And as our news editor, she's going to ask you some much sharper questions than perhaps I might. So Sahar, let me pass you over to host the Q&A.
Thank you very much for the introduction, Andrew. I hope that you can all hear me okay. That brings us to the end of our discussion, which leaves us around 10 to 15 minutes for our Q&A. So if you'd like to ask a question to any one of our panelists, please just write it in the chat box and I'll ask it as soon as I'm able to. I can already see a few in the chat function, and I do have a few of my own questions. So let me start with one of mine. This is for Gillian and Doug. You mentioned that there has been a decrease in client demand for sustainable investments. So I wanted to ask you, should advisors continue incorporating sustainable investing principles into their client portfolios despite this decrease?
I give this to you.
So I think that it's a really important question, but I'll go back to what Philip was saying, which is, in the long run, sustainable investing is going to have an impact on the way that the client views their portfolio, the way that the people that inherit a portfolio is going to view it, and so on. And I think, look, you can read the academic evidence, and there's a real kind of heated debate about, does sustainability add value in terms of investment return? I think that is, that's something which we shouldn't be leading on. What we should be leading on is how you get your money to engage in a way that doesn't cause harm. And actually, we're moving towards a world where we can even have impact portfolios that do positive good. So I think fundamentally, if you believe in those things and that your clients believe in those things, it's a good thing to be focusing on. It may not be for all clients. We know that lots of people are very skeptical about sustainability, regulation around sustainability, the way that companies talk about it, and so on. But we are moving into a world where we've got some really interesting regulation that helps clear things up. And it does feel to me that that when you think about these things and you include it in the process, people do engage with it, and they think it's a good thing, and it can help you sustain kind of people's belief in the way that their money's doing work for them, both in terms of achieving their financial objectives and kind of what it's achieving more broadly. So I think my answer is yes, but I think I totally understand when people don't think that because their clients may not say so. But I think in the long run, Philip put it really, really well. It's a good thing to be including for the sustainability of your own business. In terms of kind of revenue streams and engagement from your clients.
Thank you very much for that. Also moving on to consumer duty, because it is a topic that we touched upon. How are you expecting consumer duty to influence advisors' long-term financial planning discussions with their clients?
Gosh, there's a broad question. I don't know if Philip wants to take that one first, but that's a whole different place, isn't it?
Yeah. Well, I think to begin with, we're thinking about it in a sort of structured way. The first port of call is, how does it affect how we run the business? What is the proposition? How do we deliver the proposition? How do we demonstrate we're delivering value for money? How do we do it in a fair way to similar cohorts of clients. So that's the thing that we're grappling with first. I guess then the conversations with clients will then go into the delivery phase. So if you're going to say this is what we do to deliver value for money, you've got to have a means of actually doing that beyond just the first 6 months. And that goes into interactivity, being able to react quickly to client requests, into information flows, into the stuff that you give to help educate clients to make more informed decisions as part of the planning process, you know, all of these sorts of things. So I think it'll just feed through into proposition and delivery. And then once you're sure you're confident in being able to do that, then I think you start to engage properly with the clients, because there's no point over promising and under delivering. Sort of how I think about it, really.
Thank you for that. I also have a question around AI, which is a fascinating topic. And it's no secret that there is lots of skepticism from advisors around the use of AI in the industry. How can advisors reassure clients about the security and ethical use of AI in managing their financial portfolios?
I'm going to take, I think that's a great question.
A great question, yeah.
Yeah, because we're already starting to see advisors think about implementing it. And many of the advisors that we're working with were saying, do you know what, this is an area where you actually need some professional help and you need to think about it really carefully. We've heard anecdotally about advisors putting suitability reports into, you know, ChatGPT. It essentially is putting potentially client data online. And in fact, an advisor spoke to me a few weeks ago and said, we are starting to think about how we put an AI policy into our business, which I think is great. And obviously, I think at some point there will probably be some regulation around how this is going to work. So, you know, I guess my advice would be, you know, speak to some of the experts, and there's certainly a few around now that can help advisors. But really think about, you know, where you're putting client data and how you're using it would be my advice at this stage, because we're still in very early stages of all of this. Yeah, I don't know, Philip, if you're thinking about this at all.
Well, we're probably all going to live through the first major AI data, you know, data escape scandal, aren't we, within the next couple of years, I guess. I probably think that most clients' fears about AI and its use of AI and their data security the turrets will be turned on places like their bank long before they'll be turned on places like the financial advisor, where they have a far more, you know, a relationship of far greater depth and longevity. But it is an important point, because it goes to the heart of your security and how that's set up and what your protocols are and how much you can rely upon them. And you know, that comes, you know, back to some of my earlier points. That's not a cheap thing to provide.
Yeah,
if you want to do it properly.
I think we're still in sort of test and learn phase, aren't we? I mean, we're obviously using it as anybody would imagine in Schroders. We're able to record meetings like this. We have our own version of AI here that we can use. It can summarize a meeting and pull out actions, and then we can store that as file notes. So if you think about it, I joke about my colleagues on a Friday sitting, writing up the file notes, and now we can automate that. However, that still needs a 4 eyes check as the AI is learning. So, you know, we talk about training AI, and we talk about AI hallucinating and making things up. So I think whilst we're really excited about the possibilities, I think there's still got to be a bit of caution applied, and you know, having a check over something before you use it with a client or store it somewhere, I think.
Yeah, I think we're some way away from just feeding it into the sausage machine and taking it out, putting it in a box, and, you know, pressing send on the email.
Yeah,
definitely.
Thank you very much for that. I can see a question in the chat function, which is also around AI. The question is, how quickly do you think AI will integrate with products with providers?
Oh, goodness me. What are we in nearly 40 years of Oregon? We haven't quite cracked it yet, have we? So I suspect I may not live long enough. Gillian, I don't know if you've got a more optimistic view, but
I guess it depends on what we mean by the question. I mean, obviously, in terms of integrating with products, one of the areas Doug might want to cover is it is potentially giving us really interesting investment opportunities. In terms of the different layers within AI, you know, the different parts of it. This is not just about ChatGPT, is it? It's about all the other technology that sits around it. So, but actually in terms of I guess it's an interesting question as to where you could use it. I'd love to think at some point that, going back to sustainability, if I could pick 4 sustainable development goals, I can then get a product without having to go to a fully bespoke solution, which might not be appropriate for me in terms of additional services, that could meet my requirements. Now, wouldn't that be a great result? Or it can be used, if you think about drawdown and some of the complexities, are there areas that we can use it there to make sure that I can get a regular income and then take lump sums when I need it? Now, maybe I'm ever the optimist and doing a bit of on the cuff, off the cuff blue sky thinking here, but I do think that, this will, I think this will happen, and it might be more quickly than some of us think. I don't know.
I mean, it depends how you think about integrating AI, right? So I think you could argue some financial products are already integrating it, because everything from an active investment team sitting downstairs underneath me right now, their investment processes are becoming more efficient and more able to screen data, analyze their decisions, kind of because they are using AI to kind of replace things that used to be done by spreadsheets or by analysts, and that's making them better at their judgments and understanding what they're doing. So you could argue that that's starting to filter in already. I think what's quite interesting on integration, when you sort of think about products that are going out to a client used by an advisor, I mean, the AI is already becoming integrated in what we do. My grammar is terrible. I've always been told off for bad grammar, right? My emails are getting corrected all the time. My phone's being corrected. These things are starting to filter into the apps, the software, everything we use in a gradual way, where it's almost becoming.
The route planner is re-optimizing every time you take a different route.
Exactly. And I think that we're already seeing it, and it may not be a big bang moment. It's just gradually. There's lots of little steps around everything that are improving, because people are improving what they do using the functionality of AI, and it's not some big bang moment where everything changes. It's a sort of a quite rapid evolution in a way that makes us all better and more efficient at what we do.
But if you ask me, do I believe it's ever going to be able to go into Phoenix, one of Phoenix's closed back books, pick up SBI Section 32 book and work out what the GMP is on contracts with 8 digits? I suspect not. So it really, you're right, it rather depends what integration means. And I think it will start with very straightforward products. There's another broadly similar question asked about using AI providing an automatic sale for cash type products or driving income. And some interesting conversations from the regulator last week about the bringing back of cross subsidy and starting to move into the balance between advice and guidance. And you absolutely could see it starting to power some of those more straightforward advice decisions where the outcome is just save. I mean, when you think about it, save somewhere, basically. You look at
Gillian's. You look at the slide that talks about the number of advisors that won't deal with people who are 50k, and the number now going up to 200k. Simple propositions for that. I mean, the FCA have started this consultation on on advice, guidance, and so on. You could see how this thing can provide simple solutions that solve things that the market, because of regulation and because it just doesn't add up anymore, can't solve. So I think that's quite interesting, how that could be quite helpful.
Yes, definitely.
Some really interesting points there. Thank you very much for that. I do have one more question of my own. It goes back to sustainability, but also touches upon consumer duty as well. In what ways can advisors encourage their clients to align their investments with socially responsible and ethical considerations?
Do you want me to start that? Well, I guess, in absolute terms, they could absolutely force it by making it the core offer, couldn't they? It could be the core default option that the overwhelming majority of their clients end up into. It's not how we approach stuff. We're very much demand led, so it tends to be individual clients who themselves want to come along and raise that as a topic. But I think as the demography changes and the client base starts to move into the next generations, I think it'll just become inescapable, because to my earlier point, the demand will rise, because more and more of those clients will be asking me, what is it I have got that can fulfill what they would like to have?
As we move to a world which you described earlier, of it's more, we're moving away from an investment-led advice towards financial planning, coaching, kind of being a support for someone in multiple facets. The questioning or understanding of your clients going to, if you start focusing more on what do you care about, what do you believe in, do you think climate, how do you feel about climate change? Do you like, how would you feel, what do you like ethically? All these sorts of things those start bringing alive a sustainable solution
Yeah, they
more
do.
than hey, I've got a great investment idea, you should invest sustainably, it's going to do better. You know, that we're moving beyond that, and it's more about, as financial advice evolves, the demographic evolves, you will end up with people naturally thinking, you know what, I can get a great market return without feeling comfortable that I'm not kind of supporting companies that I disagree with, and that feels quite good, right? And so I think that's how it's the questioning and the way you describe it and talk to clients about it that's going to be the important factor there.
It feels a bit fatuous, but to your wealth transfer point, Gillian, there's nothing more obvious to link to. You need to think about transferring wealth, and we ought to be thinking about investing in things that make sure that we've actually got something around to transfer it to. If you see what I mean? So these conversations, they're not unlinked.
Thank you very much for that. It looks like we are out of time now. So let me thank you, Gillian, Doug, and Philip. That was a really fascinating session, and thank you for your insights. If your question was not answered in the time available, don't worry. We will send it to the good folks at Schroders, and they will respond to you personally. Before we sign off for Christmas, let me tell you about our schedule of events for the first quarter of 2024. So we're straight back into action with our very popular working lunches on the 17th of January, when Baillie Gifford's Claire Shaw will give us an update on the Scottish Mortgage Investment Trust. In the last 2 weeks of January, we will be back on the road again for our traditional Q1 multi-asset roadshow, where we'll be joined by speakers from Schroders, Orbis Investments, Morningstar Investments, and 2 more to be announced shortly. Our keynote speaker for this roadshow will be Morningstar Research's Head of Research, John Miller. To be clear, the dates and destinations for the roadshow are as follows. On Tuesday, 23rd of January, we will be at a new venue for PA, the impressive Alton Hall near Leeds. On the 24th, you'll find us in Warrington, and on the 25th at the National Conference Centre in Birmingham. The following week we'll be in Bristol on 31st of January, and then finishing up in London on the 1st of February. Towards the end of February, we will be running a series of 4 regional working lunches with Orbis Investments as our partners. Orbis will be joined by Embark Group's CIO, Peter Toogood, who will be offering his views on where the best investment opportunities lie in 2024. On the 21st of February, we'll be at the Corinthian Club in Glasgow, which is on the 22nd. On the 22nd, you'll find us at Carden Park near Chester, and the following week we will be at the magnificent Vineyard near Cardiff on the 28th, and on the 29th we'll be finishing up in Aylesbury. If you're an advisor within a 30-mile radius of any of these destinations, please watch out for an invitation in your email inbox over the coming days. Moving on to March, we will be back with another digital working lunch with Baillie Gifford on the 6th, and we'll be announcing these details of the event in January. All in all, that's a total of 8 hours CPD in Q1 next year. As ever, if you wish to find information on or sign up to any one of these events, you can do so by visiting professionaladvisor.com/events. Last, but by no means least, in March, we will be celebrating the very best in our industry at the 2024 Professional Advisor Awards at the Brewery in London on the night of the 20th of March. This year, we will be welcomed by over 600 advisors and product providers to the biggest award celebration in the industry. If you or your business have been shortlisted for an award, let me take this opportunity to wish you the very best of luck. We hope to see you there on stage celebrating your victory in March. So that's it today for today's session. All that remains for me is to thank Gillian, Doug, and Philip once more for their insight and answering your questions. But as ever, our greatest thanks goes to you, our readers, for your company, not only this lunchtime, but indeed for attending any one of our professional advisor events this year. I trust that you found the past hour helpful and worthwhile. For now, let me wish you all a happy Christmas, and we very much look forward to seeing you again in the new year. Goodbye.